In February 2010, Warren Buffett purchased America's largest railroad. It was a deal valued at $44 billion, easily the biggest deal that Warren Buffett had ever done at the time. And since that purchase, Burlington Northern has paid over $40 billion in dividends to Berkshire Hathaway, now its parent company. And if the valuation of its closest comparative company, Union Pacific, is anything to go by, then it's probably at the very least tripled in value since he bought it. This video is the second in a three-part series covering some of Warren Buffett's best investments ever. So if you haven't already seen the first video in the series where we looked at some activism that Buffett did with a small little company called Sanborn Map, definitely go and check that out, and be sure to subscribe to the channel if you haven't already so that you can catch future videos in the series. In this video, I want to share the story around how this deal came to be, some of the interesting ways in which Buffett accumulated shares in the open market, and the really kind of out of character way in which he structured the deal to purchase Burlington Northern outright. Now, the story of Buffett and BNSF starts back in the first quarter of 2007. This was a time where many railroad stocks were actually going through quite a bit of trouble. If we check out the closest comparison company to BNSF, Union Pacific, over on Simply Wall Street, we'll see that the company has a pretty steady track record of stable earnings and of high returns on equity and returns on capital. Yet, back in 2007, BNSF, and they weren't really alone in this basket, was earning pretty anemic returns on equity, something in the range of about 5%. And when Buffett's Q1 13F came out in 2007, we could see that he'd actually purchased three new railroad stocks. He'd purchased BNSF, Union Pacific, and Norfolk Southern. It didn't take Buffett too long to figure out which railroad he liked the best. He actually reversed course pretty quickly and sold a lot of the shares in the other two railroads and focused his attention and his capital on accumulating more shares of Burlington Northern. Berkshire continued to buy shares in Burlington Northern right up to 2009 until the point where it was about an 11% position in Berkshire's stock portfolio, and Berkshire owned more than 20% of the entire company. And on the 3rd of November 2009, Buffett finally made an offer to buy the rest of the company, to buy the 77% or so of the shares that he didn't already own for $100 per share. Now, keep in mind that Buffett had been accumulating shares anywhere in the $70 to $90 per share range, and somewhat unusually, this $100 per share offer was going to be made up of a mix of cash and actually Berkshire stock. If you want to learn a little bit more about some of the other railroad stocks that still trade publicly, check out the first link in the description that will take you to a company report of Union Pacific on Simply Wall Street. Simply Wall Street shows you valuations, financial health metrics, and a lot of context around the broader scope of a particular company. And the first 100 people to use that link will actually get a 40% discount on Simply Wall Street if you sign up for the unlimited plan. Now, Buffett wasn't alone in his purchase of a lot of these railroad stocks. If we look through 13F data from the time, we can see that some pretty familiar names were also buying into Burlington Northern. We see Norbert Liu from Punch Card Management purchased stock in Q1 of 2009. The famous value investing firm Tweedy Brown purchased in Q1 2008. Prem Watsa purchased in Q4 2008. Bruce Berkowitz purchased in Q4 2009, right around the time that the acquisition deal was announced. And Phil Town actually has written pretty extensively about being a shareholder of Burlington Northern at that time as well. He believed that the company shares were significantly undervalued, or on sale as Phil Town likes to call it back then. He thought they had basically like a textbook toll bridge moat where you have to literally use railroads from Burlington Northern in order to, use their service. And they also had a really classic kind of low-cost producer moat as well, where they were by far and away the cheapest transporter of bulk freight like coal, for example. Now, when Buffett was first accumulating shares in Burlington, he actually did it in a couple of different ways. Firstly, he just kind of conventionally bought shares in the open market like any other regular person would. But on top of that, he also wrote some pretty large put option contracts on Burlington. Some SEC filings from December 2008 show that he sold put options expiring 2 months later in January 2009 on 2.325 million Burlington Northern Santa Fe shares with a $75 strike price and for a premium of $6.35 per share. Basically what that means is that Buffett received about $14.8 million up front for writing that put option contract, and if between the start of the contract and the end of the contract, which in this case was early December 2008 to the end of January 2009, so about a 2-month period, if the shares went below $75, he would be obligated to buy those shares from the person who bought the put option contract. So the premium that Buffett captured there was about a 9.2% yield, which looks very attractive in only a 2-month kind of period of time. But unfortunately for Buffett, the shares of Burlington Northern actually dropped more than 9%, and he was forced to buy them at $75 a share when they were trading in the $66 range in 2009 on the open market. But nonetheless, it shows that Buffett really wasn't messing around here. He was getting a little creative in terms of accumulating a stake in the company, and it's one of the best examples we actually have of Buffett using option contracts in a value investing context. Moving now to the actual deal, there are a couple of really interesting aspects to how Buffett went about buying BNSF. Now, keep in mind he already had a significant shareholding in the company, so the deal that he offered BNSF shareholders $100 a share was actually for the remaining 77.4% of stock that Berkshire didn't already own. And one of the things that made this interesting is that Warren Buffett is typically a cash buyer of businesses. He's been pretty famous over the past couple of years, especially for building up huge piles of cash and having the ability to spend it very quickly on buying businesses. But this was in 2009, a couple of years after the financial crisis, and Buffett had basically tapped out his entire kind of cash pile. He'd spent it buying very cheap stocks and making a bunch of deals in the financial crisis. And in order to fund this massive acquisition of Burlington Northern, he had to actually take on some debt. And he also issued some Berkshire stock, which is very out of character for Buffett. And this is what Buffett actually had to say about his attitude typically towards issuing shares in Berkshire.
Why does Burlington Northern make sense? If you're going to be splitting the stock and paying for part of this deal in stock, which you traditionally hate doing.
I hate it. I've written the annual report, and I say that, I enjoy issuing shares at Berkshire about as much as I enjoy prepping for a colonoscopy. I mean, this is not my idea of fun.
And to Buffett's credit, he also wanted to have this deal structured in a way to where the little guy, the very small shareholder in BNSF, got the same deal as the large shareholder. And again, this is what Buffett had to say on that topic.
I want to talk a little bit about why we're here today, and that's for Berkshire Hathaway's special shareholder meeting. This is a very unusual event. The idea of splitting the Class B shares 50 for 1. Why are you doing this?
Shows you what happens when you get to be 79.
Some people are asking if you are completely changing your stance on a lot of different issues.
No.
Somebody was saying, is this going to be a dividends coming soon too?
No, I don't think it means that. And it made sense in terms of the Burlington Northern acquisition, because otherwise we wanted to give a stock and cash option to their shareholders, and to really effectively give it to the smaller shareholder, we had to have something with a lower denomination than our Class B shares, which were in the $3,000 plus range. The big shareholder would have gotten a different deal than the small shareholder otherwise, and so it was an easy decision, actually.
So there's a few moving parts here, but put very simply, Berkshire would fund this deal with 60% cash, 40% stock, and they would also assume $10 billion in debt from Burlington Northern when they made the acquisition. Berkshire was actually so short on cash at the time that to raise that 60% cash component for the deal, Berkshire actually took on about $8 billion more debt to kind of fund that component. And as you saw in that clip, Buffett really wanted all BNF shareholders to get the same offer. So again, pretty out of character. He actually split his B shares 50 for 1. And that now gave BNSF shareholders kind of an option for their $100 a share, that they were selling their BNF shares to Buffett for. They could choose to either receive cash or stock. And if we look at the 13F of someone like Norbert Liu with Punch Card Management, we see Berkshire Hathaway in his portfolio. He actually never bought those shares out in the open market. Those Berkshire shares actually all came from this BNSF transaction. So it was very clear that Buffett wanted to make this deal happen. And he was quoted as saying, "We paid right up for Burlington, no question about that." He felt it was a pretty full price for the company, but on top of that, he was giving away something that was really precious to him, which was his Berkshire stock. And he actually felt that Berkshire stock was trading at a pretty low valuation. And looking back at the time, it was trading at about 1.2 times book, which is well under the threshold now at which Berkshire has bought back stock in the past. So clearly reasonably cheap. And he actually said in an interview with Becky Quick at the time that he felt that he was really paying more than $100 per share because the currency he was paying for a portion of that deal with, which was his stock, he felt that that was also undervalued. But there are a couple of reasons that Buffett really wanted to make this deal happen. Firstly, Burlington has a huge moat. No one is going to come in and lay down railroad tracks all over the US and start competing with Burlington Northern. He really views this as like a 100-year asset with a monster competitive advantage. He also more than once has referenced the ability for Berkshire to deploy capital internally within Burlington Northern at attractive rates. Now, we have to remember that Berkshire is like this compounding machine. It's like a snowball rolling down a hill, constantly getting bigger. They own a bunch of operating businesses that produce cash every year. They own a stock portfolio that pays them dividends every year. And it's Buffett's job to take that cash and redeploy it at high rates of return. And from time to time, he really struggles with that. Yet, Burlington Northern was the type of company that if he owned it outright, would give him the opportunity to keep funneling money back into the business, to grow it, to make it more profitable, and he would be earning, double-digit returns on that reinvestment engine. So for all those reasons, Buffett made this deal happen, and it was effectively valued at an enterprise value of about $44 billion if we account for all of the debt that Berkshire would assume from Burlington as well. So how has it worked out since, and what is BNSF worth today? Well, BNSF obviously trades just as a component of Berkshire Hathaway. There is no BNSF stock price that we can look up to see how it performs, but we do have a few pretty nice comparisons. So we know that in 2021, Burlington Northern had earnings of about $6 billion. This is something that Buffett writes about in his most recent letter to shareholders. And if we compare that to some of the other railroads, Union Pacific, we can see that had about $6.5 billion of earnings, and that has an enterprise value of $158 billion. So if we use that same multiple of earnings, that would imply that BNSF would be worth about $145 billion today. Canadian Pacific, which is a smaller railroad, earned $2.2 billion, has an enterprise value of $79 billion, which would imply, if the same multiple again was put on BNSF, that it was worth $215 billion today. And finally, we have kind of the king of valuation when it comes to Berkshire, which is Mr. Chris Bloomstrand. He writes extensively about Berkshire every single year in his letter to his shareholders in his fund. And he has the Burlington Northern component of Berkshire valued somewhere between $115 and $135 billion. So you had a deal valued at $44 billion back in 2010, which is probably worth $120, maybe even $150 billion today. So the enterprise value for Buffett has grown about 3 times, but you have to remember that there was quite a bit of borrowed money involved in this situation, and Buffett's return on equity that was generated for shareholders is likely much higher than that 3 or 4x. As of 2020, Berkshire had also received $41.8 billion in dividends from BNSF, which basically means they got all of their purchase price back more or less as well. And again, this reinvestment engine has been really useful for Berkshire. Since the BNSF acquisition, they've had the opportunity to put about $41 billion to work. That's as of 2020, again, at attractive rates of return because they own BNSF. Now, the big question here for me is, was the issuing stock component of this deal worth it? Now, if we look back, we can see that Berkshire stock is up about 3.4 times since 2010, and it's pretty likely that BNSF has grown at a faster rate than that. So you can definitely make the argument that issuing stock to do the deal did in the end make sense. BNSF has probably grown 3 or 4 times in value as well. But we've also got that massive amount of dividend money that's come in the door for Berkshire. So I do hope you enjoyed that story of Berkshire's acquisition of BNSF. It's now one of the 4 giants at the overall Berkshire company, and there's a lot of kind of nuanced elements to this story which really show, why Buffett is one of the best to ever do it. He really wanted to make this deal happen. He got pretty creative in purchasing the stock in the first place, and then he got even more creative in making this outright purchase happen. So I do hope you enjoyed the video. If you did, please subscribe to the channel. I would really appreciate that, and that way you can see future videos as soon as I upload them as well. But that's it from me for this one, and I'll see you in the next video. Cheers.